Owning a home for many is part of the American dream. Our story begins in the small, quiet neighborhood of Bailey Park in Bedford Falls. Let's meet the Martini family. They are planning to buy their first house in Bailey Park. In order to purchase the home, the Martini family must take out a mortgage loan. They plan to make a 20% down payment and finance the remainder with a 30-year fixed mortgage loan. Mr. and Mrs. Martini visit the Building and Loan Association and meet with a loan officer to discuss obtaining a loan. They heard about the Building and Loan Association after the bank threw a barbecue and invited all residents of Bedford Falls to learn more about their products. Not only does the bank offer mortgage loans, but they offer a variety of other loan products to consumers and businesses. Of course, they also provide deposit holder services. The Martinis fill out an application and submit it to the loan officer and pay a loan application fee. The loan officer reviews their application, asks the Martinis a few questions, and performs a credit check. The loan officer then grants the loan pre-approval status, which means it will now be submitted to the underwriting department to go through the full loan approval process. Now that they have been pre-approved, the Martinis place an offer on the house, and it is accepted. Next, the Martinis submit lots of documentation to the bank so that their loan can be fully approved. The underwriting department reviews the documentation, obtains updated borrower FICO credit scores, and pays a qualified independent appraisal company to verify the home's value. Concerned that interest rates are going to go up as this process drags on, the Martinis decide to pay a fee due at loan closing to lock in their loan at the current interest rate. A few weeks later, the loan is approved, the deal closes, the title transfers, and the Martinis become the proud owners of their new home. Wait a minute, is that it? It's great that the Martinis bought their new home, but what about the bank? What takes place behind the scenes?
How do I know that the Martinis are going to actually make their payments? Did the underwriting department do a good job in reviewing this loan? What happens if the collateral value of the home declines? Is someone going to periodically review the loan, including things like the collateral value? What happens if the Martinis don't pay? Do I have to write off the loan? If so, when? How do I account for the loan application and interest rate buy-down fees? What about the costs incurred to originate the loan, such as the appraisal fees and the costs for the underwriting department? And what about the costs for that barbecue I held? Those folks ate a lot of hamburgers and hot dogs. It ended up costing the bank a fortune.
Thankfully, that is what this training is all about. While many of you are probably familiar with the lending process from the borrower's perspective, like the Martinis, you may not be as familiar with what happens behind the scenes at the bank. Along with the lending process, there are also lots of accounting considerations for loans and their associated fees and costs. This course will explore aspects of the lending process and the accounting for various types of loans. Let the story begin.